I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the Friday morning call. So obviously the big focus this morning after we broke above 1,700 on the S&P yesterday was going to be the jobs report. The jobs report is out, and it's a very disappointing one after everybody was sort of expecting a big number to potentially get the ball rolling towards faster economic growth, to potentially pave the way for that QE tapering from the Fed in September. But this jobs report brings us a little bit of a curveball. It's sort of the opposite of what we saw last month. We saw this morning we saw a number that came in lower than the headline number. Is 162,000 non-farm payrolls created in July versus expectations of 185,000. You also saw the June number revised lower, and you saw the participation rate go down, which resulted in a lower unemployment rate. But a lower unemployment rate is actually a negative thing, like I talked about with the participation rate. Fewer people are looking for jobs, more people are dropping out of the labor force because they're discouraged workers and haven't been able to find a job. So that's a negative. Just like last month, the uptick in the unemployment rate was actually a good thing if you understand how the unemployment rate is calculated. But a weak report, futures were up slightly heading into the report, and now are
I'm Mark
ticking,
Sperling, Director of Trading with
We'll go ahead and take a look at the chart here, the S&P. I'll take a look at the daily, and then we'll take a look at the pre-market. On the daily chart, obviously yesterday we had that big breakout above 1,700, the psychological level that my colleague and T3 Live Chief Strategic Officer Scott Redler has been talking about in the media and various of our content newsletters over the past few years, year, whatever you want to say. So this morning last time I checked, around the 170 level, so I'll go ahead and take a look at it. But if we do open around that level, all it really is us giving back the intraday gains from yesterday. So you see us here around 170.18. So far found support at that 170 level this morning. We go back to the daily chart. Like I said, that would just be erasing the intraday gains from yesterday. So if this is the extent of the damage today on this jobs report, obviously not a big deal. We could rest today, summer Friday. Maybe the jobs report provides the impetus for a little bit more volatility. But overall, if the damage is contained, nothing to cry about. And I don't think this jobs report was bad enough for the Fed to really alter its course on QE and change its tone at that September rate decision. But it's interesting to see whether the dynamic is good news and bad news is bad news, because for a long time in this market we had that dynamic that bad news was good news because it meant the QE would continue indefinitely. There would be no eyes toward the exit like the Fed is having right now. But like I said, I don't think this jobs report was bad enough that it could be perceived as something that would change the Fed's mindset. If that's the case, the Fed is a little bit too micro in their view of things. But it'll be interesting to see the way the market interprets this today, whether people look to buy this pre-market dip with the expectations that the QE might not dry up as quickly as they might have thought, but it'll be interesting to watch. Obviously, whenever we get a jobs report or economic data, the two things we look at most closely are gold and bonds to see how they react, especially the bond markets are very telling. Obviously, if people think QE is going to continue at its current pace for longer, gold will tick higher, TLT bonds will tick higher, and that's what we're seeing so far this morning. We go and take a look at the chart of GLD. Like I said, gold is ticking higher this morning on that jobs report. It's been holding up fairly well. Yesterday it was a little bit weak, traded down into its 21-day moving average. But overall it's been in a sort of descending channel here after filling this gap from the big macro breakdown that happened in mid to late June. So a descending channel obviously is bearish because it's going down, it's descending. But if you get a break above a descending channel, it can trigger some momentum, and that's a pattern we talk about. You don't want to cheat this pattern and get in gold before a break of the descending channel, because you could get stuck in that channel for longer than you feel comfortable with. But if you do get a break above a key level, we can draw the trend line here on this channel. If we do get a break above that, today, which we can measure that level at, let's just say 128.50. We look where gold is pre-market, so it's not near that level yet. In the context of the recent action, it looks like this is a decent move in gold, but it's really not. It's up around the 27 area, 126.50 after ticking down here a little bit. But you take a look at that. Yesterday's high was 127.89, so we're not even at that level yet. So it'll be interesting to see whether gold gets more of a bid during the session today, or whether, like I said, this jobs report wasn't bad enough that people think this is really going to change the Fed's rhetoric and change the Fed's game plan in terms of potentially tapering in September. Take a look at the chart of TLT. I can get off my line tool here. Hold on. All right, TLT. Bonds, been trickling lower. Yesterday, TLT opened down and traded down more after rebounding well the previous session. Scott watches the TBT a little bit more, which is the inverse leveraged bond ETF, but you see the same story from Wednesday in TLT, is that it gapped down big but closed the gap, but then that comeback was not sustained and obviously closed below all these pivot lows. This morning we'll look at it pre-market TLT up around 106.50 area. So we look at that on the daily chart, 106.50. In the context of yesterday's, that's right at yesterday's opening price. So sort of like the S&P is now down, looks set to open near yesterday's opening price. The TLT, the bond ETF, looks set to open back at its opening price from yesterday, and we'll see if it can reclaim some lost support levels and things like that. But to go into more of a stock-specific look in the market today, which has been the mode you should be in, I think in general, when you're trading, I don't think there's a ton of edge trading the indices, to be honest with you. Trading the spiders, this and that, yeah, you could have some winning trades in the spiders and in indexes and things like that, but I don't think there's an edge there. I think you have much more of an edge if maybe you take into account some of your forecasts on what direction you think the market's going to go, and you take a very stock-specific approach. You could even trade a lot of stocks without even worrying about the market, because I think it's much easier to predict things that are going to happen with individual companies based on the mechanics of those stocks and things like that, rather than trying to forecast moves in the broader market, which are much more prone to gyrations due to algorithms and all kinds of different things. But there's a group of stocks that IPO'd within the last couple of years. You can call them new media stocks. Some of them are social media, some of them are websites, various different things. But that group of stocks had a lot of skepticism that accompanied them when they IPO'd. Some people talking about how bankers were piggies and that the IPOs were valued too high, and these companies, while they get a lot of traffic and usage, don't really have a future in terms of being able to make money. And recently we've seen, even just this quarter, we've seen a huge uptick. This past year also we've seen big runs in these stocks. Obviously LinkedIn is a high profile name in that group, but I'm going to go over a few of those stocks that have really perked up and accelerated to the upside recently, and especially this quarter. The first one we'll take a look at is LinkedIn. Like I said, that's more of a perennial winner in this group. Ever since its IPO, it's been very strong. But as we're zoomed in here from June, it looked like the stock might break down a little bit in June. I was a little bearish on it after this earnings report. LinkedIn had impressive earnings reports up to that point, beat expectations almost every time. But right here, it missed on expectations, gapped down, went to the downside after that gap. So if you see a gap and go to the downside, sometimes that tells you more downside in store. Did have a little bit more downside, but held what looks like the 100-day moving average here, and then went back to highs prior to its earnings report. And then after the close yesterday, LinkedIn reported earnings and is up about 10% this morning, 9 or 10%, up near the 234 level. So you can't keep LinkedIn down. I remember the IPO day for LinkedIn, the stock ripped to $120 after being priced well lower than that. We can actually probably take a look at it here on the daily chart. You see this IPO day. I want to zoom in so you get a better look at it. But it was a crazy day, one of the more successful IPOs that it triggered a lot of hype for the Facebook IPO, and we all know how that turned out. But LinkedIn, opened for trading at $83, traded all the way up to around $125. It did close well off its highs that day, but that was just an example of some of the hype and the interest that was surrounding this IPO. And successful IPOs lead to healthy lives for stocks, and obviously LinkedIn has doubled from that IPO day high. So really impressive action for LinkedIn. It's going to continue this morning. This will continue to be something on the radar of active traders, as it's a very high beta, high momentum, high volatility stock. definitely be on your radar today. Is it be interesting to see how it deals with that gap. Facebook, obviously well publicized, most recent earnings report. The gap and go, which tells you that this thing has more upside in store. I think it'll be above $40 before you know it. It's hard to chase psychologically when you see a 40% move up in a stock, but I do think it'll get more upside. I'm not in love with Facebook from a fundamental, a user perspective or a technical perspective. It's obviously improved a lot, but it's not one that I am eager to put in the drawer, especially at these levels. From a trading perspective, though, like I said, all the technicals right now after this gap up point to more upside. It had that reversal day, that red dog reversal on Wednesday, but reclaimed most of that yesterday. It did close off its highs yesterday, but reclaimed most of those Wednesday losses. So really healthy action from Facebook. And then Yelp. We'll take a look at the Yelp chart. That was a big winner yesterday. If you've been following the market closely, you probably saw those headlines. Yelp up big on earnings. Another one of those new media stocks like I talked about. We can take a look at the monthly just to get a picture of Yelp since its IPO. And this is just a textbook wedge pattern, something that we teach in our courses very often. We highlight a lot in Off the Charts is stocks that form wedge patterns. This one was listed way back a few months ago on Off the Charts out of that wedge pattern. Really, really impressive move, textbook move out of a wedge type pattern. And it's doubled in that time since breaking out of that pattern. It was digesting the IPO and trying to find its footing and its identity as a company, and it's done that really well. Huge gap up, obviously, on this earnings report. Really impressive action from Yelp, and it held that gap, so maybe you could see some more upside there. Going back to the daily chart, we'll take a look at Zillow and Trulia, two of these new real estate media sites that I love using Zillow. You know, I'm a little bit young to be aggressively buying real estate, but I love to look at it anyways, and the way I do that is on Zillow. Zillow, you can go around, you can look at apartment listings, you can look at sale listings on houses, apartments in New York, vacation homes, whatever you want to do, and it's a really fun site to be on. I think it's the future of real estate. You know, real estate's one of those industries that I think was stuck a little bit in the past. You have your real estate broker charges a commission and blah, blah, blah. Now everyone has access to all these listings via Zillow. And I think it's a really great website, and I think the story of the stock is starting to catch up with that. I know somebody like Howard Lindzen, one of the founders of StockTwits. He's someone I follow on Twitter who's always been very bullish on Zillow, and I've enjoyed reading what he writes about them. But I agree with that thesis that this is one that has a bright future. It's another one that on its IPO took some time to digest that IPO, and then after a few months of being public, or about 6 months in this case, broke above this range, and it's not looked back since. It's doubled also, just like Yelp. So really good gains on new IPOs. That's why, you know, we talk sometimes about Noodles. NDLS is a stock that it IPO'd, had a really good first day of its IPO, has been really low volume, really light, and sort of been twisting in the wind a little bit as volume has dried up since that IPO day. But it's one that I think could have a bright future as well. So if you do get some commitment on some volume out of a break of a pattern in NDLS, we'll take a look at it. Like I said, very thin. Look at the daily chart of it, you get a better look. Huge move on the first 3 days after its IPO, based, formed a wedge, whatever you want to call it. Looked like it was going to go on this day, but like I said, really light volume, really thin, came back all the way in, but it's still holding. So until it breaks below this range, I think you could be involved in this trade, and hopefully some volume will come in and push it higher. But Trulia is one that I mentioned that's like Zillow, really strong move. That's what triggered the Zillow move, was the earnings and the move in Trulia. Trulia did close well off its highs, but we can take a look at the long-term chart of that. Same thing. It took some time to find its footing after the IPO, but has more than doubled since then. Really huge moves in these new media stocks. Definitely something to keep an eye on. Hard to chase psychologically, but anything's possible when you're introducing disruptive technology. So definitely something worth watching. I'll go through really quickly. I've been long-winded and talking about all this other stuff. I'll go real quickly through high beta tech. Talk about Apple. Apple gapped up on earnings, held the gap, and it's pushed higher. It's trying to contend with this resistance level right here around 457. So that'll be something to keep an eye on, whether it can push above that. If it gets above that, it has another resistance point here at 465, 466. So everything's healthy with Apple right now. Could be a turning point. There's talk that they're pursuing new products more aggressively. I think that would be the big catalyst for Apple, and I think Apple, on a long-term basis, in my opinion, is a good buy in this area still. A buy at 390 obviously would have done well to this point, but I'm a believer in Apple. Everyone talks about Tim Cook not doing his job, losing Steve Jobs, huge blow to the stock and the company, and they'll never recover from it. I don't agree with that. I think they have a lot of talent there. They've seen a little bit of talent drain, but I think they still have the talent there to innovate and come out with new products that will be disruptive into the future, well into the future. So Netflix, on earnings, it's another one, sort of like LinkedIn last earnings season. It has recently beaten expectations on every earnings report, had a bunch of gap ups and bases, as you can see here. After it bounced back from that $60 area, had a gap up and base, gap up and base. This most recent earnings report wasn't as impressive, but it's still one that I think people really love. It held its 21-day moving average for the most part, as it had a few closes just below it, but now it's back above its 8 and 21 day. I think it's one that could get some dip buying interest here, and I think a lot of people talk about it being a potential takeover target for a lot of different companies who want to get into that new media streaming business. So I think Netflix, I don't think you'll see a huge correction in the stock. If you do get a pullback to something like the $200 price level, I think it's a screaming buy. I think this is one that keep on your radar, see if you get some sort of buyable dip, because I do think any significant dip will be buyable. Amazon. Another one gets a pass from Wall Street every earnings season, and everybody huffs and puffs on Twitter about it, and they say, oh, it's not fair. Amazon keeps missing on earnings. I'm short. Why isn't it going down? Blah, blah, blah. Fact of the matter is, Amazon is such a well-run company. Jeff Bezos, one of the most respected CEOs on Wall Street. Yes, they don't really make money yet, but they're investing a ton in the future in their storage business, data storage, in their online streaming business. They're the main competitor in a lot of ways to Netflix, besides things like HBO and heavy content sites. But they're doing a great job investing in a lot of things that are the future in various sectors. And I think once they do arrive and they start making money, I think it's going to be a really big trajectory on their earnings per share. Obviously, the stock is pricing that in, but I think it really could be a high-speed freight train with Amazon in terms of that company's ability to make money once this big investment phase ends for them and they start growing their revenue streams in those areas. Google, another one I love long-term. Obviously, it's tough after a huge run in Google to feel good about buying it, but I think you can continue to put money to work in a company that has separated itself as the biggest innovator in tech. Obviously, they have all these things like Google Glass and the Google Loon, the wireless internet thing with hot air balloons, and they devote a lot of their employees' time to these far-reaching, far-out projects, and I think that's very important as the pace of technology and technology development accelerates over time. And I think we're seeing a period of that. Things that we thought were going to be science fiction type things are coming to fruition right now. I posted an article on my Twitter a few days ago about, we have Google Glass, and there's basically Google contact lenses. Google's not the one that came out with this, but like LED contact lenses that are like Google Glass, that you can see projections and you can live in a virtual reality world via contact lenses. It's something that I was lucky enough to go to the SALT conference hosted by Skybridge. A guy, Michio Kaku, a famous Japanese physicist, talked about the idea of contacts, being able to project virtual reality, and that obviously has huge implications for all kinds of business, and Google's usually ahead on those types of projects, so it's one that, yeah, has come a long way. It's above $900 a share. It's capital intensive, but I think you continue to put money to work over time in Google, you're going to come out a winner. I don't think it's overextended right now. The PE is not out of control or anything like that, so from a pure value perspective, I think it's still attractive to me. GMCR is one that's highlighted Monday as Mark Sperling's trade idea of the week. Continues to inch higher. I think it looks really good. Has about a week until earnings to squeeze back up into the upper end of this range, which was the target range we gave on that hypothetical trade idea. But really nice action so far from GMCR after it gapped up, formed a base, and is pushing higher. It's one of the high short float that could squeeze into the top end of that range, like I said, as shorts get a little bit scared going into the next earnings report. After last earnings season, GMCR delivered a really blockbuster report. Priceline, one that some people had a short thesis on it after that Expedia earnings report that was really, really weak, potentially as a red flag for the online cheap travel websites, whatever you want to call that niche sector. And Priceline has actually distanced itself significantly from Expedia, and looks like, until earnings, it'll be interesting to see what happens with Priceline, but looks for now like it's holding in this upper range and could blast off again. Maybe beat Google to the punch to be a $1,000 stock, but who knows? Much more of a believer in Google. I don't know enough about that sector to really have any conviction about it, but technically speaking, it's holding up well. but not an A-plus play, but just something I thought was worth pointing out. And then the last thing I'll talk about is the credit cards. I think you have to take a look at this sector because of the volatility we've seen in recent days. Basically, what happened is you had MasterCard come out with a really, really bullish earnings report, gapped up above $620 area, obviously really healthy action. Then you had that ruling come down from a San Francisco judge saying that the Fed didn't have authority to cap debit card fees. They capped them, I think, at 21 cents. And the judge basically said they don't have the authority to cap those, and they should be capped lower than they are because rates that high are predatory in terms of debit card fees. So all the credit card stocks tick down sharply lower, ones that have exposure to debit cards, but MasterCard has much less exposure to debit cards than something like Visa does. So what you saw initially was a snap reaction to that announcement that the judge was getting rid of the Fed's authority to cap those debit card fees. MasterCard went sharply lower, but then as people sort of digested it, they realized, like I said, MasterCard doesn't have as much exposure to debit cards. It's not going to be that big of a deal for MasterCard. In addition to, you don't know how this news is going to work out, how it's going to play out. Are they actually going to cap debit card fees a lot lower? That remains to be seen. And as you saw, a huge snapback in MasterCard up to near the $650 area. So this has really separated itself within the credit card space and is an extremely strong stock that I think should be on short-term traders' radars, especially as one, in addition to being one that long-term I think is something like Google that I think you continue to put money to work in the credit cards. Visa, larger exposure to debit cards. I talk about MasterCard separating itself. It's separating itself from Visa. Honestly, those are two stocks that trade in lockstep a lot of times, and people look towards sympathy trades when one of these has news or earnings. But Visa ticked down sharply lower on that debit card ruling, and then yesterday tried to gap up, but traded lower, traded well off its lows into the close, but still not the best action there. But continue to see if Visa finds its footing. Like I said, nothing's set in stone about whether some other regulator is going to come in and cap debit card fees lower than 21 cents. It was just the judge basically saying the Fed doesn't have that authority. So that news could play out any number of ways, and Visa could be right back to where it was before that news, around 195 before you know it, depending on how that shakes out. You don't want to put yourself at the disposal of news and judges and rulings and things like that, because sometimes those people can be a little bit misguided. But this is one that I think could potentially be a dip buy. You have big one-time news events like the JP Morgan London whale situation, like the BP oil spill, things like that, or like the Boeing thing, for example, with the batteries on their new planes not working properly. When you have things like that cause initial shocks lower in a stock, I think so many times you see those stocks recover back to the levels that they were prior to that big news. Yes, it is a short-term hit to the stock, and companies lose a lot of money off them, whatever, but I think they are buying opportunities for the most part, and JP Morgan has been up huge, for example, since the London whale stuff came out. When they finally reported the loss that was the result of that London whale, the stock surged in response to that because they love just having that black cloud and that bad news out of the way and not having to worry about speculation. So everybody should be watching closely the news wires on Visa, but like I said, I think it could be a dip buying opportunity. This has been John Darsie here for your morning call. As usual, I get a little long-winded. Scott usually hogs the spotlight in here, so I like to come in here and give you a little bit of my perspective. I think it's a little bit different than Scott's, so hope you enjoyed it. Have a good Friday. Could be some action in the market due to the earnings report, or the jobs report, excuse me. But this has been John Darsie. We'll see you back here on Monday for the morning call.